Hello students, good evening. Before I start with, I apologize due to unfortunate demise of my Vedanana. I could not attend live for last 3 days. Finally, I am back. I welcome you all for this beautiful topic of trust tax. Before we start with, there is my website newly designed www.phoenixbyuma.com. If you want to interact with me, okay, either Instagram, WhatsApp, Telegram, or you wanted to call me or you wanted to mail me, entire details are given in my website. So you just need to click www.phoenixbyuma.com. Like all my social media things, mobile, mail ID, everything is available there. Free resources were also provided there. So you can check my website, everything relating to me you can find in my website. So please navigate to my website. First, today's topic is trust taxation. Very important chapter in CA final. At least 8 to 10 marks can be expected from this chapter. Definitely one question will come from. So I request everyone to listen carefully till the end of this live session. Okay. Sir, what are the sections that we are going to discuss in this revision series of trust? We will discuss section 11, 12, 13, 115 BBC anonymous donations, 115 BBI, and 1023C related section. All these sections will be discussed in this class. First, I will start with section 11. I will take a fresh page. What section 11 says? First of all, section 11 says income derived from property held under trust. Whatever the income derived from property held under trust is there. For that, certain exemptions are given under section 11 and 12. The income derived from property held under trust of charitable or religious trust. Whatever that income is there, out of that income, 15% standard deduction is allowed. That means 15% of such income is not at all taxable and only balance 85% is taxable. Sir, what do you mean by charitable or religious trust? Charitable trust means any trust that is formed for to help poor or for the relief of poor or for the upliftment of poor. So the trust we call as charitable trust. Religious trust means any trust whose main objective is promotion of that particular religion. The trust we call as religious trust. So what section 11 says, whatever the income derived from property held under trust of charitable or religious trust is there. From that income, you can claim exemption under section 11 and 12. Now the question is, sir, what do you mean by income derived from property held under trust? Income derived from property held under trust means we can say rental income. For example, trust is having a function hall. Function hall is given on rent for marriage. So by giving function hall on rent, you are getting rental income. That rental income you can call as income derived from property held under. See, big trusts are there like TTD and Shirdi Sai Trust, Sri Sailam Trust. So many trusts are there. All these trusts, whatever the income that they receive, all that income they are going to claim exemption under section 11. So what section 11 says, income derived from property held under trust is eligible for exemption under section 11. Income derived includes rental income, not only rental income. See, what is the main income of trust? Donations. If you go to Tirupati, you will deposit some money in the hundi. Okay, so even whatever the donation income is there, even donation income is also considered as income derived from property held under trust. These donations are classified into two types: general donations, corpus donations. General donations are like treated as income derived from property held under trust. And whatever the corpus donation is there, corpus donation is not at all taxable. Corpus donation is fully exempt, subject to the condition whatever the amount received for corpus fund is there, that is to be deposited in safe modes as per section 11.5. Okay, what are those safe modes I will discuss little later, but for the time being please remember, like general donations are treated as income derived from property held under trust. Corpus donation is fully exempt. Sir, what do you mean by corpus trust? If any donation is given with specific direction, the donation should be used as a corpus fund of the trust. Then that donation we call as corpus fund, okay, or corpus donation. Let's say I went to Tirumala Tirupati Devasthanam. I gave 10 lakh rupees donation. I gave instruction. This 10 lakh rupees should be form part of corpus fund of TTD. Then that type of donation we call as corpus donation. So corpus donation is like capital receipt which is not used generally unless in exceptional situations. Income derived from property held under trust also includes income from movable assets. Let's say on shares and securities you will get interest income and dividend income. Even that income is also considered as income derived from property held under trust. So income from movable property. Anyhow, income from immovable properties is also treated as income derived from property held under trust. Next, whatever the business income is there. See, Tirumala Tirupati Devasthanam is there. It is selling laddus. It is selling agarbattis. That is also business, na? So, if business is incidental to attainment of main objectives of the trust, then even that business income is also considered as income derived from property held under trust. Are you able to understand? Give me 1 second. ISKCON temple is there. It sell Bhagavad Gita books. Selling of Bhagavad Gita books is incidental to main objectives of ISKCON. So even that business income is also considered as income derived from property held under trust. But the only thing is, whatever the business income is there, for that separate books of accounts are to be maintained and are required to get audited. Then only business income will be included in income derived from property held under trust. Whatever the income that forms part of income derived from property held under trust is there, from that you can claim section 11 and 12 exemption. Capital gains. See, trust will have capital assets, right? On sale of capital assets, whatever the capital gains that are received are there. Even capital gains are also considered as income derived from property held under trust. Next, if there are any other receipts, even other receipts will also be considered as income derived from property held under trust. Let's say you wanted to do charity, you got some amount out of the donation, that will be included as income derived from property held under. Now, what I said, whatever income derived from property held under trust is there, out of that, 15% is straight away not at all taxable. 15% will be set aside. 15% standard deduction will be allowed, and only balance remaining 85% is taxable. So, income derived from property held under trust. So, out of this, 15% standard deduction is allowed. 15% standard deduction allowed. Balance 85% is there, right? Remaining 85%. Out of remaining 85%, whatever the amount that is applied for charitable or religious purposes is there, that is eligible for deduction. What do you mean by this? Let's say, for example, income derived from property held under trust is 80 lakh rupees. Out of 80 lakh rupees, 15% standard deduction is allowed. 80 lakhs into 15%, how much? 12 lakhs is standard deduction. How much is balance? 80 lakhs minus 12 lakhs, 68 lakhs. So out of 68 lakhs, whatever the amount that I have applied for charitable or religious purpose is there, that is allowed as deduction. Whatever the amount applied for charitable or religious purpose is there, that is allowed as deduction. Let's take an assumption I applied 20 lakh rupees for charitable or religious purpose. That will be allowed as deduction. Sir, you are saying 20%, like you are saying applied for charitable or religious purpose is allowed as deduction. What do you mean by applied? Applied means any expenditure incurred by trust for attaining its main objectives. Whatever the expenditure, TTD is incurring expenditure of salaries of employees and like daily annadhanam expenditure. So whatever the expenditure incurred by trust to achieve its main objectives is there, that expenditure we can consider as applied for charitable or religious purpose. Another important point, applied means both revenue expenditure and capital expenditure. Let's say there is Umasankar Trust. Okay, I constructed a temple in that trust. In that temple, there is also a function hall. I wanted to give that function hall on rent. From that function hall, whatever the rental income that I receive, that rental income will be considered income derived from property held under trust. Now the thing is, in that function hall, it is normal function hall. I wanted to convert it into AC function hall. So I installed 8 ACs. Each air conditioner cost is 50,000 rupees. 50,000 into 8, 4 lakh rupees. It is capital expenditure na. Still total 4 lakhs will be allowed as deduction, because whatever the amount that I spent for charitable or religious purpose is there, whether it is revenue expenditure or capital expenditure, total expenditure will be treated as applied. Are you able to understand? So both revenue expenditure and capital expenditure will be allowed as deduction. Another important point, you will get doubt, sir, 4 lakh rupees air conditioners I claimed as expenditure, I treated it as applied. Again on that 4 lakhs, will depreciation is allowed? No. Once you claim 100% of the capital expenditure, again depreciation is not allowed. So the thing is, once you claim capital expenditure, again depreciation in second year is not allowed. Who said? As per section 11.6. Okay. So the thing is, whatever the amount that you have applied for charitable or religious purpose is there, entire amount, whether it is revenue or capital expenditure, is treated as applied. But if you claim capital expenditure as applied, depreciation on such capital expenditure is not eligible for deduction from second year onwards as per section 11.6. So out of 68 lakh rupees, I claimed 20 lakhs. How much is balance? Balance is 48 lakhs. Sir, is there any way that I can reduce this 48 lakhs also? Before that, let me tell one point. Generally, whatever the income derived from property held under trust is there, 15% set aside. Standard deduction is allowed. Balance 85% is taxable. Out of that 85%, whatever the amount applied for charitable or religious purpose is there, that is allowed as deduction. Balance is taxable as per slab rates. Trust is AOP na, so for AOP slab rates are applicable, right? So whatever the income that is left after charitable or religious purpose is there, that is taxable at the rate of slab rates. If trust follows default tax regime, those slab rates are applicable, otherwise normal slab rates are applicable. Now next point is, sir, is there any way that we can reduce this 48 lakhs also? Here we need to pay tax on 48 lakhs. Can we reduce our income? Is there any possibility? Yes, there is possibility. What is that possibility? Explanation explanation 1 of section 11.1. So as per explanation 1 of section 11.1, there are two ways further you can reduce your income. First option available is outstanding amount. Sir, what do you mean by this? I have function hall na. On 20th March 2025, I gave function hall on rent. Rent amount is 5 lakh rupees. I took advance of 1 lakh rupees. Balance 4 lakh rupees I did not receive. How much is rent? Rent is 5 lakhs. I received advance of 1 lakh. Balance 4 lakh was not received. Trust is following accrual basis of accounting. If trust is following accrual basis of accounting, then 5 lakhs will be included in the 68 lakhs, right? 5 lakhs will be included in 68 lakhs. In the 68 lakhs, 5 lakhs will be included. But how much I received? I received only 1 lakh rupees. On 20th marriage, on 20th March, there is marriage, but marriage got cancelled. Okay. So, like, there is disturbance and marriage got cancelled. Those people did not give money to the trust. Now what happened? I received only 1 lakh rupees advance, but as per accrual basis of accounting, I need to include 5 lakh rupees in my total income. So now the thing is, whatever the amount that I did not receive, 4 lakh rupees, for those 4 lakh rupees, I will file declaration to assessing officer. Sir, whatever the outstanding amount is there, that outstanding amount I will apply in the previous year in which it is received or in the immediately next financial year. Are you able to understand? And now itself I will take that deduction. So here I will claim 4 lakhs as deduction. So 5 lakhs is rent, 1 lakh rupees I have received, balance 4 lakh rupees I did not get. In future I may get. So in future, whenever I receive that 4 lakh rupees, either in that year or in immediately next financial year, I will apply that 4 lakh rupees. Stating all this, I will file declaration to assessing officer. Then by filing declaration, I can claim it as deduction. But this declaration should be filed within 2 months before the ITR due date. Then only this deduction is available. Now, next year, the same girl came. Okay, so the marriage got cancelled. The same girl with another bridegroom, he came and got marriage done in our temple trust. At the time, she said, sir, earlier year marriage got cancelled. We were not able to give you the money, but right now I am getting married. So she paid balance arrears 4 lakh rupees also. 4 lakh rupees received in 25-26. So in 25-26, I should apply 4 lakh rupees for my charitable or religious purpose. Or in the immediately next financial year, in 26-27, I should apply 4 lakhs for my charitable or religious purpose. If I fail to apply, then whatever the amount that I did not apply, it is taxable under section 115 BBI at the rate of 30%. Let's say this is the story of previous year 24-25. In previous year 26-27, this 4 lakh rupees was received. So whatever 4 lakhs received is there, that I should apply either in 26-27 or what is immediately next financial year 27-28. So out of 4 lakh rupees, I applied 2.5 lakhs. I did not apply, applied till 31st March 2028. That means before 27-28, I could apply only 2.5 lakhs. 1.5 lakh was not applied. As it is not applied, this is taxable under section 115 BBI at the rate of 30%. Are you able to understand? So as per explanation 1 of section 11.1, if there is any outstanding amount, if you are following accrual basis of accounting and if entire amount is included in income derived from property held under trust, whatever the amount that you could not receive in current year is there, that you can claim as deduction. But the year in which you receive that amount, in that year you should apply, or in the immediately next financial year you should apply. If you fail to apply, whatever the amount that you did not apply is there, that amount is taxable under section 115 BBI at the rate of 30%. Are you able to understand? Second option, bumper donation. Sir, what do you mean by bumper donation? On 31st March, I got 8 lakh rupees. How much I got? Bumper donation 8 lakh rupees. If I get on 31st March, how can I apply it in one day, enter 8 lakh rupees? That is not possible, na? So if I get any bumper donation at the end of the previous year or for any other reason, whatever the amount that is there, I can file again declaration to assessing officer. Sir, like I can file declaration to income tax authority. What is the time limit? Within 2 months before ITR due date, I should file application to assessing officer, and whatever the amount is there, bumper donation, like I will file declaration, I will spend this amount in the immediately next financial year. So in 24-25 I got bumper donation of 8 lakh rupees. I could not apply in 24-25. So what I will do, I will give declaration 8 lakh rupees I will apply in 25-26, for which AO will grant acceptance. Okay, so in 25-26 I should definitely apply 8 lakh rupees. If I fail to apply 8 lakh rupees, then whatever the amount that I could not apply in 25-26 is there, that is taxable under section 115 BBI at the rate of 30%. So what I will do, in current previous year on 31st March, I got 8 lakh rupees bumper donation. Total 8 lakh rupees I will claim as deduction. So whatever 8 lakh rupees is there, that I should apply in 25-26. But out of 8 lakh rupees, 5 lakh rupees I applied, 3 lakh rupees was not applied. Whatever the amount that was not applied is there, that amount is taxable under section 115 BBI at the rate of 30%. Next, shall I explain further? Sir, out of 48 lakhs, we have reduced our income by 12 lakhs. 48 minus 12, 36 lakhs. Now, are we required to pay tax on 36 lakhs, or is there any further choice? Yes, further choice is available. If one trust gives donation to another trust, whatever the donation given to another trust is there, that is also eligible for deduction. So, like general donation by one trust to another registered trust, one trust to another registered trust. But total donation given is not eligible, not treated as applied. Only 85% of donation given is treated as applied. Let's say Umasankar Trust gave 2 lakh rupees donation to Monish Trust. Now how much is donation given? Donation given is 2 lakh rupees. Total 2 lakhs is not treated as applied. Out of 2 lakhs, 85% is treated as applied, 1.7 lakhs. So very important, only 85% of donation given is treated as applied. Another important point, if one trust gives corpus donation to another trust, that is not treated as applied. Only if general donation is given, then only it will be treated as applied. Whatever the general donation given, total general donation is not treated as applied. Only 85% of general donation given will be treated as. If I borrow any loan, whatever the loan amount that I have borrowed, that loan amount I will incur in current previous year. Let's say like trust is charitable, I am not getting much income. So I took 1 lakh rupees loan. 1 lakh rupees, using this 1 lakh rupees loan, I paid salaries of all employees of the trust. The year in which I took loan and I paid salaries, in this year that will not be treated as applied. Let's say in 24-25 I took loan. In 24-25 I took loan of rupees 1 lakh. Using this 1 lakh I paid salaries. Out of this 1 lakh rupees I paid salaries in 24-25. Whether it is treated as applied in 24-25? No, it is not treated as applied in 24-25. This 1 lakh rupees, like I repaid loan along with interest, loan plus interest, 1,20,000 rupees in 25-26. In 25-26, it is treated as applied. That means what? The year in which you took the loan for the purpose of salaries, in that year it will not be allowed as deduction. In that year it will not be treated as applied. But whatever the loan that you have taken, that loan you will repay na, the year in which you repay the loan along with interest, both loan repayment, interest expenditure, both are allowed as deduction in the year of repayment. Are you able to understand? So how much is the loan that I took? I took loan of rupees 1 lakh rupees, whether in 24-25, is it allowed as deduction? No. The year in which you took the loan, that is not the criteria. The year in which you repay the loan, that is the criteria. Okay. So loan or borrowing repaid along with interest. So the year in which you repay the loan along with interest, in that year it is allowed as deduction. Are you able to understand? Accumulation under section 11.2. Sir, what do you mean by accumulation under section 11.2? There is a temple under my trust. For that temple, I wanted to build another function hall. Already one function hall is there, that is congested. I wanted to build second function hall with bigger area. See, I am getting donations. I am not denying it. With 1 year donations, can I build function hall? That is not possible. So what I will do, like I will accumulate the amount every year. After accumulating the amount, I will use this amount for the purpose of construction of another function. So like this is the thing that is used in many offices. Whatever the income is there on which tax is payable, like they will create some specific purpose. Let's say I wanted to build a function hall, that is specific purpose. For that, I will accumulate the money. So I should give declaration to assessing officer under section 11.2 before 2 months before ITR due date. In that declaration, I will tell specified purpose. What is specified purpose? Specified purpose is construction of function hall. I will tell how many years that I will accumulate. Maximum I can accumulate is 5 years. See, this is 24-25 na. Ignore current previous year. Other than current previous year, in next 5 years, I can accumulate the money. I can build the function hall. I can utilize all this money for the purpose of construction of this function hall. And in current previous year, I can claim it as applied. Are you able to understand? So till here, how much is there? Like 36 minus 1.7. 34.3 lakhs is there. So out of 34.3 lakhs, I wanted to accumulate 10 lakh rupees. Let's say to construct function hall, it will cost me 50 lakh rupees. I wanted to accumulate every year 10 lakh rupees. So what I will do every year, like I will accumulate. I will tell the specified period. I can tell period 2 years, 3 years, 4 years, like that. Maximum I can tell 5 years. Maximum period allowed is 5 years other than current previous year. Other than current previous year, maximum I can accumulate for 5 years. Next, third point, whatever the accumulation that I have done, what I am doing, I am accumulating 10 lakh rupees for the purpose of construction of function hall. This 10 lakh rupees I should deposit in safe modes. Then only deduction is allowed. Otherwise, deduction is not allowed. So you should deposit in safe mode. That is next point. Last point, whatever the amount 10 lakh rupees that you deposit in safe mode is there, that should not be given as donation to another trust. Okay, should not be given as donation to another trust. If all these four conditions are satisfied, then you can accumulate the money for specific purpose for specified period, and whatever the money that you have accumulated, that you can claim as deduction. Are you able to understand? So I hope you are all following. I think there is delay that's going on. So yeah, four conditions. If you want to accumulate money for specific purpose, four conditions. You should give declaration to assessing officer before 2 months before ITR due date. In that declaration, you should tell specific purpose, you should tell specific period, you should deposit that money in safe mode, and you should not use that money for any donation to any other trust. If all these four conditions are satisfied, and if you have given declaration to income tax authority before 2 months, then whatever the amount that you have accumulated, that you can claim as deduction. Now there are chances you can violate these conditions. In current year you will claim 10 lakhs as applied, but in future year you may violate the condition. You may treat this money for other purpose, or you will after 5 years, like you said you will construct function hall in 5 years. After 5 years, out of 10 lakh rupees, only 9 lakh rupees was used, 1 lakh rupees was unutilized. So whatever the unutilized money is there after expiry, and like you said you will deposit in safe modes, but you have deposited in other modes. You said you will not give donation to any other trust, but you have given donation. All these are violations, so whatever the violation is there, all these are violations. So whatever the violation is there in the year of violation, these are taxable under section 115 BBI at the rate of 30%. Year of violation, taxable under section 115 BBI at the rate of. So that is the concept relating to section 11.2. Here one important point is there, maximum accumulation allowed is 5 years other than current previous year. So like I gave declaration, I specified 5 years. Now I wanted to buy land for the purpose of construction of function hall, but I gave advance for land also. After 1 year, that land was under litigation and court gave stay on that land. Whatever the time that I lost because of stay by court, okay, that period is to be excluded while calculating this 5 years. Are you able to understand? We discussed corpus fund, right? Initially, corpus fund. Generally, there is Trust Act as per Indian laws. As per that Trust Act, you should not use corpus fund. Only in emergency cases, you can use corpus fund. Let's say Tirumal Tirupati Devasthanam is there. COVID has come, no devotees are coming, no deposit, no devotees are giving donations. So TTD has to pay salaries to all its staff. It has to pay electricity expenditure, and all expenses are there. Donations are not coming, but it needs to pay expenses. So there is no income, but expenditure is there, outflow is there. To incur that expenditure, TTD is not having money. Then what TTD will do? TTD will take some amount out of corpus fund and use this amount for the purpose of payment of expenses. So like the year in which you take amount out of corpus fund in 21-22, in previous year 21-22, 15 lakhs, let's say, like we are discussing about Umasankar Trust, 15 lakhs was taken out of Umasankar Trust corpus fund, okay, corpus fund, and this amount is used for payment of all expense. In 24-25, what I have done, I got income 15 lakh rupees. This 15 lakh rupees, like I have used it for repaying to corpus fund. That means what? I repaid back of 15 lakh. I took 15 lakhs from corpus fund in 21-22. Now, whatever 15 lakhs that I took and paid salaries in 21-22, that amount I repaid back to corpus fund in 24-25. In 24-25, it is allowed as applied. See, here observe. In 21-22, I took 15 lakh rupees. I paid salaries in 21-22, but the year in which I paid salaries, in that year it is not treated as applied. It is treated as applied in the year in which I repaid back that amount to corpus fund. Are you able to understand? So another deduction allowed is income used for deposit back to corpus fund. Deposit back to corpus fund. 15 lakh rupees. Here there is one important point. I took money from corpus fund. I spent this amount for salaries. The year in which I took out the money, when I took out the money, I took out the money in 21-22. So previous year 21-22, ignore. Next 5 years. Next 5 years means 22-23, 23-24, 24-25, 25-26, 26-27. So on or before 26-27, I should repay back to corpus fund. Then only it is treated as applied. If I repay back in 27-28, it is not treated as applied. So whatever the amount that is taken out of corpus fund is there, that you should repay it back to corpus fund within 5 years from the end of the year in which you withdraw that money. Then only it will be treated as applied. Otherwise it will not be treated as applied. Are you able to understand? So most of the points I have covered. After reducing this 15 lakhs, how much is balance available? Balance available is 34.3 minus 10 lakhs minus 15 lakhs. Balance 9.3 lakhs is available. This 9.3 lakhs is taxable at slab rate. Do you remember 40A3 in PGBP? Per person per day, you should not make cash payment of more than 10,000 rupees. 40A3 provisions are also applicable for charitable or religious trust. That means whenever you are incurring revenue expenditure or capital expenditure per person per day, if you make cash payment of more than 10,000 rupees, it will not be treated as applied. Are you able to understand? Next, 40A3. Next, 40A1A. When you are making payment to resident, two conditions are there. You should deduct TDS before 31st March of previous year, and deducted TDS you should deposit to government before ITR due date. If both these conditions are satisfied, then 100% of the expenditure is allowed. Otherwise, 30% of the expenditure is disallowed. Same provisions are applicable for trust as well. Are you able to understand? So, 2 points. If you make cash payment of more than 10,000 rupees per person per day, that will not be treated as applied. When you are making payment, you forgot to deduct TDS, or you deducted TDS but you did not deposit to government, that will also not to be treated as applied. Are you able to see here? You paid in cash more than 10,000 rupees per person per day. In current year, it will be disallowed and it will be treated as income. So 40A3, 40A3A, 40A1A, all these three provisions which we have studied in PGBP, same are applicable for trust taxation also. Okay, so this is how we are going to calculate income of charitable or religious trust as per section 11.1. Section 11. I hope you understood it. So quickly I will revise. Whatever the income derived from property held under trust is there, 15% is not taxable. Standard deduction is allowed. We will set aside. Out of balance 85%, whatever the amount applied for charitable or religious purpose is there, it is allowed, whether it is revenue expenditure or capital expenditure. Next. Yeah, explanation 1 of section 11.1. If there is any outstanding amount, you will give declaration. That outstanding amount you will claim as deduction. If you get any bumper donation, that also you will give declaration and you will claim as deduction. But outstanding amount, bumper donation. Outstanding amount you should apply in the year of receipt or in the immediately next financial year. Otherwise, whatever the amount that you did not apply, taxable under 115 BBI at the rate of 30%. Next, bumper donation you should apply in immediately next financial year. If you fail to apply, whatever the amount that is not applied, taxable under 115 BBI at the rate of 30%. If one trust gives donation to another trust, total donation given, general donation given not allowed, only 85% of donation given will be treated as applied. So if you take any loan or borrowing, the year in which you use that money, in that year it is not treated as applied, but the year in which you repay the loan, then in that only it will be treated as applied. Otherwise it is loophole. You will take loan, you will claim expenditure, you will never repay the loan. Okay, so it's like understanding, for the purpose of claiming expenditure you are intentionally taking loan. That's why it was counted. The year in which you repay the loan along with interest, in that year it will be treated as applied. Next, accumulation under section 11.2. Like if you want to accumulate your money, which we normally use in our offices, you can give declaration. In that declaration, 4 points: specified purpose, specified period, maximum 5 years other than current previous year, deposit in safe modes, you should not give that money as donation to any other trust. If any of these four conditions are violated, in the year of violation, whatever the amount violated is there, that is taxable under 115 BBI at the rate of 30%. So what is ITR due date? 31st October. 2 months before ITR due date means on or before 31st August, you should give declaration and you can claim it as deduction. Next, if you take any money from corpus fund and use that money in the year of usage, it is not treated as applied, but in the year in which you are actually repaying it back to corpus fund, in that year it will be treated as applied. Whatever the balance income is there, that is taxable as per slab rate. And provisions of 40A3, 40A3A, 40A1A are applicable. Now, explanation 5 of section 11.1. See, if current year expenditure is more than the income, then excess expenditure you cannot set off and you cannot carry forward. What do you mean by this? Income derived from property held under trust is 200 lakhs. You applied for charitable purpose 190 lakhs. Now, how it will be, whatever the income derived from property held under trust is there, 15% set aside na. So how much is 15%? 200 lakhs into 50%, 15%, 30 lakhs. 13 lakhs is fully exempted. It is not at all taxable. How much is remaining? 85%. Remaining 85% is 170 lakhs. Out of 170 lakhs, how much you have applied? You have applied 190 lakhs. Whether 190 lakhs is allowed? No. So here there is deficit of 20 lakhs. Na? There is deficit of 20 lakhs. Can you carry forward to next year? Answer is no. You cannot carry forward to next year. It cannot be carried forward and it cannot be set off. Are you able to understand? So excess application in current previous year, you cannot carry forward and you cannot set off with any other income. As per Finance Act 2022, general explanation added for whole section 11. For whole section. What is the general explanation? As per the general explanation, accrual based expense. Accrual based expense only treated as applied. Treated as applied. Sorry. Accrual based expenditure is not treated as applied. Cash based expense only treated as applied. What do you mean by this? See, at the end of previous year, my salaries are 6 lakh rupees. Out of 6 lakh rupees, I paid 4 lakhs, unpaid 2 lakhs. For example, this salary was not considered. I am following accrual basis of accounting. Can I claim 6 lakhs as deduction? Not allowed. Only 4 lakhs will be allowed as. That means what? In case of trust, whatever the expenditure that is incurred by trust, that expenditure is allowed only if it is paid in current previous year. Otherwise, it is not allowed as deduction. Now you will get one doubt. Sir, you said outstanding amount And you also said accumulation as per section 11(2). You said bumper donation. See, if you file declaration, then you can claim it as deduction. For example, salaries is there. 4 lakhs I paid in current previous year. Remaining 2 lakhs I did not pay in current previous year. I gave declaration to assessing officer within 2 months before ITR due date. Then I can claim 2 lakhs as deduction. If I do not give declaration, if I do not give declaration to assessing officer, whatever the accrual based expenditure is there, as able to understand. So for whole section 11, whatever the expenses are there, those expenses are treated as applied only if they are actually paid in current previous year. Otherwise, they are not allowed as deduction on accrual basis. They will not be treated as applied on accrual basis unless you give declaration to as able to understand. Sir, till now you are saying safe mode under section 11(5). What do you mean by, like, what are all the various modes that are covered under section 11(5) that we will discuss. So, safe modes under section 11(5). See, government certificates. Trust can invest its money in government certificates. It is allowed investment. Okay. So government certificates means nothing but national saving certificates or any other certificates issued by government. If you invest, if trust invests its money in national saving certificates, that will be treated as applied only. It is safe mode. Next, post office savings bank account. Next, if you deposit your money in scheduled bank, deposit in scheduled bank, that is also allowed. For accumulation under section 11(2), we discussed it now. Whatever the amount that is accumulated, that should be deposited in safe modes. What are those safe modes? Government securities, post office savings bank account, deposit in scheduled bank, deposit in cooperative society bank. Next, investments in units of UTI. You know UTI, right? Unit Trust of India. So trust can purchase units of UTI. That is safe mode of investment only. That is allowed. Next, investment in central government or state government securities. That is also permitted. Trust can invest its money in central government or state government securities. That is also treated as a safe mode of investment. It is also allowed. Next. Next point, a bit tricky, but listen, you will understand. Debentures of company or corporation which are guaranteed by central government or state government. Let's say there is Reliance Limited. It issued debentures. Whatever debentures issued by Reliance Limited are there, repayment of those debentures along with interest, that is guaranteed by central government. You can invest those deposits. Trust can invest in those debentures. That will be treated as safe mode of investment in public sector company bonds. Public sector company bonds. Next, deposits in public financial institutions, investment in public sector company shares, investment in public sector company, investment in immovable property. The renowned educational institution, you all know, okay, they are taking benefit like this only. Whatever the fees collected from students is there, it will be treated as income derived from property held under trust. They will take benefit of section 11 to accumulation. They will invest that money in immovable properties. That's how they are purchasing so many immovable properties in their locality. Okay, that's the loophole. So investment in immovable property is safe mode of investment as per section 11(2). Investment in immovable property. I hope you understood the way how they are getting so much of income, how they are building so much of assets through this point. If you understand, leave some comment. Okay. Now, investment in housing financial corporations and investment in HUDCO, Housing Development Corporation, investment in NABARD bonds. All these are safe modes of investment. So if trust invest in all these safe modes of investments, then it is all right. It will be treated as applied. Otherwise, whatever the amount that is misutilized or misinvested is there, that will be treated as income and it is taxable under section 115 BBI. For example, like 10 lakh rupees, the example which we took for purpose of construction of function hall, how much I accumulated? I accumulated 10 lakh rupees. Out of 10 lakh rupees, with 9 lakhs, I purchased land. Land is safe mode of investment, it will be treated as applied. With 1 lakh rupees, I purchased cryptocurrency. Whether cryptocurrency is safe mode of investment? No. 1 lakh will not be treated as applied. Are you able to understand? So this is the concept relating to safe mode of investment under section. Next, we will discuss section 13.1. Certain cases, whatever the exemption under section 11 are there, exemption under section 11, 12, exemption under section 11 and 12 is not available in 4 cases. What are those 4 cases? First case, if you create any trust for private religious purposes, then in such case, you cannot claim exemption under section 11.12. For example, I created one trust, Maganti Trust. In that trust, like I build one Shiva temple. For that Shiva temple, I can enter, only my family members can enter, my friends can enter. So if I create any such type of trust only for private religious purpose, the trust is not eligible for section 11 and 12 exemption. If you establish any trust for particular religion or caste or community, even that trust is also not eligible for exemption under section 11.12. Let's say I built one temple. Okay, I told for that temple only Hindus are allowed, others are not allowed. Okay, that's why you will never see in any temple only Hindus are allowed. If such type of placard or notice is given, that trust is not eligible for 11 and 12 exemption. In TTD, can you see anywhere only Hindus are allowed? No, they will not give that disclosure. If such disclosure is given, it will lose status of section 11 and 12 exemption. So if you create any trust for particular religion, particular caste, particular community, the trust is not eligible for section 11 and 12 exemption. But if you create any trust for orphans or widows or for particular backward people, then the trust is eligible for 11 and 12 exemption. Now, Varun is asking, sir, only for widows, those who are suffering with marriage, or those who are suffering with wives, for them also if we create any trust, is it also eligible for 11 and 12 exemption? Yes, that is also eligible for 11 and 12 exemption. So those who are suffering with breakup, those who are suffering with all the nuisance in the house with marriage, for those husbands also, if you create any trust, the trust is also eligible for section 11 and 12 exemption. Okay, so you need not worry if you have any such kind of people. Create one trust and you can claim 11 and 12 exemption. Third point, if any amount of trust is used for benefit of specified person. Okay, so benefit of income or assets given to a specified person. Then not total amount. Whatever the benefit that is given to specified person is there, that amount will be treated as income, and such income is taxable, like, and such income is taxable under section 115 BBI at the rate of 30%. What do you mean by this? Let's say I established one education institution. In that education institution, my sister is studying. How I charge fees for outsider, in the same way I should charge fees for my sister as well. If I do not charge fees for my sister, whatever the benefit that my sister has received, that benefit will be treated as income of the trust. On such income, trust is required to pay tax under section 115 BBI at the rate of 30%. Are you able to understand? So whatever the benefit that trust gives to its specified person, on that benefit will be treated as income of trust. On that income, trust is required to pay tax under section 115 BBI at the rate of 30%. Are you able to understand? Sir, who are called as specified persons? Whoever the founder or author of trust is there, or whoever the manager or trustee of the trust is there, they will be treated as specified person. Similarly, if any person gives donation of more than 50,000 rupees, why will he give more than 50,000 donation? He might have some specified interest. So those who have given donation more than 50,000 rupees, for that person also, if trust gives any favor, if trust provides any benefit, that benefit will be treated as income of the trust. So those who have given donation more than 50,000, they will also be treated as specified persons, and their relatives, whoever founder, author, manager, trustee is there, their relatives will also be treated as specified person. Similarly, if trustee is Hindu undivided family, if you know Simhachalam temple trustee is one Hindu undivided family. Okay, so if trustee of the trustees Hindu undivided family, whoever the members in the trustees are there, all the members will be treated as specified persons. Okay, so members of HUF, if HUF is trustee. Are you able to understand? So all these will be treated as specified persons. For specified persons, if any benefit is provided, such benefit is taxable under section 115 BBI at the rate of 30%. Another important point, whatever the amount that is taxable under section 115 BBI is there, from such income, you cannot claim any expenditure, you cannot claim any deduction, you cannot set off any losses. Whatever the income taxable under 115 BBI is there, that is taxable at flat rate of 30%. When I say flat, no deduction, no expenditure is allowed, straight away 30% tax is payable on that income. Are you able to understand? Next, fourth case. If funds of trust are deposited in any mode other than section 11.5, other than 11.5, in that case also, whatever the amount that is deposited in modes other than 11.5, cryptocurrency, whatever the amount that is misutilized, that is not invested in safe mode, to the extent of that amount, it is taxable under 115 BBI at the rate of 30%. Able to understand? Why trust can be formed? Can someone tell? Trust can be formed for charitable purpose, or it can be formed for relief of poor, or it can be formed for yoga, or it can be formed for education, or it can be formed for providing health facilities, or it can be formed for preservation of environment, or monuments. For all these purposes, like trust is formed for purpose of education, I created Umasankar Educational Institutions and I created one trust. In the trust, I am running a school. Through school, I am getting income. Na? So in all these cases, if you do business, and in business, if business receipts are more than 20% of total receipts, then also still section 11 and 12 exemption is available. Still section 11 and 12 exemption is available. But if I create any trust for advancement of any other object, yes, Monish said sports. Even for promotion of sports also, you can create one trust. Education, sports, games, you can create one trust, and the trust, in the trust, whatever the business income is there, even if business income is more than 20% of total receipts, still you can claim section 11 and 12 exemption. But if you create any trust for advancement of any other object of general public utility, in this case, if you create a trust for this purpose, and for that trust, if business receipts are less than or equal to 20% of total receipts, then 11 and 12 exemption is allowed. But if business receipts are more than 20% of total receipts, in that case, 11 and 12 exemption is not allowed. See, registration will not be cancelled. I created one trust for the purpose of helping poor. Okay, so helping poor trust. So that is, no object was there. That is for upliftment of general public or to help the poor. Now, using that, what I am doing, I am purchasing bottles at 10 rupees. Intentionally, I am selling it at 40 rupees. I gave notice. Whatever the amount that I receive by selling these bottles, I will distribute this money to poor. Now, what am I doing? I am doing business. So, in my business, if my business receipts are more than 20% of total receipts, my trust registration under 12AB it will not be cancelled. But in current previous year, section 11 and 12 exemption is not available. Are you able to understand? Further, trustee is required to maintain books of accounts and trustee is required to get its books of accounts audited if total income of trustee is more than basic exemption. So there are certain cases if books of accounts are not maintained, or if books of accounts are not audited, trustee is required to file ITR before on or before 31st October. If trust do not file ITR within due date, do not file ITR within due date, or if business receipts are more than 20% of total receipts in case of advancement of any other object of general public utility. Okay, this particular case, advancement of any other object of general public utility and business receipts are more than 20% of total receipts. So in all these three cases, if books of accounts are not maintained, if they are not audited, or if ITR is not filed within the due date, or in case of trust is formed for advancement of any other object of general public utility, and if business receipts are more than 20% of total receipt, in all these cases, only revenue expenditure is treated as applied. Capital expenditure is not treated as applied. See what I said, income derived from property held under trust, 15% standard deduction, balance 85%. Out of balance 85%, whatever you apply for charitable or religious purpose, application means both revenue expenditure and capital expenditure. Both expenses are treated as applied. But in these four cases, capital expenditure is not treated as applied. Only revenue expenditure will be treated as applied. applied. Are you able to understand? Because violated na, books of accounts are not maintaining, they are not getting audit done, they are not filing ITR within due date, business receipts are more than 20% of receipts, conditions given are violated. So only revenue expenditure will be allowed as deduction. Even this revenue expenditure should not be from corpus fund. This revenue expenditure should not be from corpus. So if revenue expenditure is from corpus fund, again it will not be allowed as deduction. And this revenue expenditure should not be from any loan or borrowing, because if revenue expenditure is from any loan or borrowing, it will not be allowed in current year. It will be allowed in the year in which you repay the loan. So it should not be from loan or borrowing. And it should not be depreciation for which 100% deduction is allowed in earlier years, for which 100% deduction allowed in earlier years. So this is the thing. In all these four cases, as you have violated the condition, revenue expenditure will not be allowed as, capital expenditure will not be allowed as deduction. Only revenue expenditure will be treated as applied. Even in that revenue expenditure also, if you incur any revenue expenditure out of corpus fund, that will not be treated as applied. If you incur any revenue expenditure out of loan or borrowing, that is not treated as applied. Earlier year you have claimed 100% capital expenditure. For that asset you want to claim depreciation now. That is also not allowed. Are you able to understand? Capital gains. This will be interesting. Listen. Section 11(1)(a). See, trust will have assets na. Whenever trust sell assets, on sale of capital assets, trust is also required to calculate capital gains. Whatever the capital gain is there, that capital gain will be considered as income derived from property held under trust. Do you remember? Initially, I told even capital gain is also considered as income derived from property under trust. Got. Okay, so trust is having one land. It sold that land for 14 crores. Let's say transfer expenses are 1 crore. How much is net consideration? Net consideration is 13 crores. Cost of acquisition. Cost of acquisition is 8 crores. Now how much is capital gain? Capital gain is 5 crores. Sir, can we claim any exemption from capital gain? Yes, you can claim exemption from capital gain, but you need to do reinvestment. Okay, the formula is if total net consideration is reinvested, total net consideration is reinvested, then total capital gain is exempted. Total capital gain is, if part of net consideration is reinvested, part of net consideration is, then exemption is equal to cost of new asset minus cost of old asset. Cost of new asset. Did you understand? Now, let's say total 14 lakhs reinvested. Reinvestment, exemption. If total net consideration is reinvested 13 crores, total 5 crores capital gain is exempted. Are you able to understand? But total 13 crores, what net consideration? Total 13 crores was not reinvested, only 11 crores was reinvested. Then how much is exemption? Cost of new asset minus cost of old asset. New asset 11 crores, old asset is 8 crores. Only 3 crores is exemption. Are you able to understand? For example, let's say 9 crores is reinvested, then 9 crores minus 8 crores. 1 crore is allowed as exemption. Are you able to understand? So if only 6 crores is reinvested, 6 crores minus 8 crores, it is negative 2 crores. In this case, exemption allowed is 0. Are you able to understand? So whenever trust sells any capital asset, then what you need to consider is net consideration. Net consideration should be reinvested. If total net consideration is reinvested, total capital gain is fully exempt. If proportionate net consideration is reinvested, then exemption is equal to cost of new asset minus cost of old asset. I hope you are following me. Next, we will discuss something interesting, anonymous donation. Okay. I framed one problem on this as well. So we can discuss that problem also after we discuss. Anonymous donation under section 115 BBC. Anonymous donation means what? Someone whom we do not know. Okay, unknown person deposited money, unknown person gave donation. It's also called as Gupta Dan. So if any anonymous donation is received, anonymous donation is taxable. So if anonymous donation is received by religious trust, anonymous donation received by religious trust, then whatever the anonymous donation received by religious trust is there, that anonymous donation we will treat as income derived from property held under trust. However, if any anonymous donation is received by charitable trust, then 115 BBC gets attracted. So in this case, 115 BBC will not get attracted. It will be treated as income derived from property held under trust. But if anonymous donation is received by charitable trust, then it is taxable under section 115 BBC. Let's say anonymous donation received is 10 lakh rupees. Anonymous donation received 10 lakh rupees. From this 10 lakh rupees, deduction is allowed. See, total 10 lakh rupees is not taxable under section 115 BBC. Deduction is allowed. How much is deduction? 5% of total donation. 5% of total donation or 1 lakh, whichever is higher. That will be allowed as deduction. And whatever the balance is there, that balance amount is taxable under section 115 BBC on a flat rate. Okay, no deduction will be allowed on a flat rate at the rate of 30%. Are you able to understand? And whatever the donation that is allowed, that is not exempt, that will be treated as income derived from property held under trust. Okay, so that should not be exempt. That will be treated as income derived from property held under. Here, sir, what do you mean by total donation? Total donation includes anonymous donation plus corpus donation plus any general donation or voluntary donation. If any government grant was received, that is also to be considered in calculation of total donation. Because see, why this concept was introduced, many people are converting black money to white money using trust concept. So they are saying unknown person gave this much of amount and they are bringing that money to the trust. So to counter this, if any unknown person gives money to the charitable trust, it will be treated as anonymous donation. But at least some people will be there now who will give, some unknown persons who will give out of genuine reasons. So further deduction will be allowed, 5% of total donation or 1 lakh rupees, whichever is higher. Balance is taxable as anonymous donations under section 115 BBC at the rate of 30%. Whatever the deduction that is allowed, that is not exempt, it will be treated as income derived from property held under. Sir, there is Uma Trust, like it is having temple, it is also having hospital. That means what? The trust is having both charitable entity, like that is charitable trust as well as religious trust. Charitable as well as religious. So if it is charitable as well as religious trust, then for charitable purpose, if it receive any anonymous donation, then 115 BBC is applicable. For other purpose, if any anonymous donation is received, then 115 BBC is not applicable. Very simple. If any trust is formed for both charitable and religious purposes, TTD, educational institution is there, religious purpose is there. So if any trust is created for both educational as well as both charitable as well as for religious purpose, for education, for health, if any anonymous donation is received, 115 BBC is applicable. For orphans and for any other purpose, if any anonymous donation is received, that is not taxable under 115 BB. Okay. Now, shall we solve one problem for better understanding? Shall we solve? There is one trust with the name Gali Trust. There is one guy who constantly commenting. How do you expect that I can reply while I am teaching the class? Gali Trust. Now, there is Gali Trust. Income derived from property held under trustees 20 lakh rupees. Next, donations received. See, even donations received is also considered as income derived from property held under trust, right? Donation received is 50 lakh. Out of 50 lakh, anonymous donation is 12 lakh. And corpus donation is 20 lakh. Next, business income incidental to main objects. If it is incidental to main objects, then it will be treated as income derived from property held under trust, right? So business income incidental to main objects is 13 lakhs, sorry, 3 lakhs. Next, amount applied for charitable or religious purpose is 30 lakh rupees. Compute total income of Gali Trust under section 115 BAC. That means if trust is paying taxes under section 115 BAC, we need to calculate the tax liability. Shall we calculate? Everybody. Now, first, we will write income derived from property held under trust. Computation of total income of Gali Trust. First, how much is income derived from property held under trust? 20 lakhs. How much are donations received? 50 lakhs. Corpus donation is not taxable, na? Corpus donation is exempt, right? If it is deposited in safe modes. So total donation is not taxable, only other than corpus, other than anonymous. See, out of anonymous donation also, total is not treated as income derived from property held under trust. 5% of total donations or 1 lakh, whichever is higher. So we will do one thing. How much is anonymous donation? Anonymous donation is 12 lakhs, right? From this 12 lakhs, deduction is allowed. How much is deduction? Deduction is 5% of total donations. So how much is total donation? 50 lakhs. 50 lakhs into 5%, 2.5 lakhs or 1 lakh, whichever is higher. That means 2.5 lakhs is allowed as deduction. How much is balance? 12 minus 2.5, 9.5 lakhs is balance. This 9.5 lakhs is taxable under 115 BBC at the rate of 30%. And whatever this 2.5 lakh is there, that will be treated as income derived from property held under. So how much is total donation received? Donation 50 lakhs. But from the donation, you need to reduce corpus donation because corpus donation is not taxable. How much is corpus donation? 20 lakhs. Next, how much is anonymous donation? Anonymous donation is 12 lakhs. How much is balance? 50 minus 32, 18 lakhs. Correct? To this, we are going to add income derived from property held under trust. So, anonymous donation total will not be treated as income derived from property held under trust. Only 2.5 lakhs it will be treated as income derived from property held under. Now, out of this, total how much? 20 plus 18 plus 2.5, 40.5 lakhs. Out of 40.5 lakhs, standard deduction is allowed na. How much is standard deduction? Standard deduction at the rate of 15%. So 40.5 into 15%, 6.075 lakhs. Let how much balance? 34.425 lakhs. I am making one small change. Please change this. Amount applied for charitable or religious purposes 21 lakhs. How much? 21 lakhs. So from this we will reduce amount applied for charitable or religious purpose. How much? 21 lakhs. How much is balance? Balance is 13.425 lakhs. So if we convert 13,42,500. So this is total income of the trust. Now shall we calculate tax liability? Total income is 13,42,500. Out of this, no, 13,42,500. To this we need to add amount taxable under 115 BBC. How much is taxable? 9,50,000. So how much is total income? 13,42,500 minus 9,50,000. 22,92,500. I hope you are following till here. So total income is 22,92,500 divided into two parts. Anonymous donation 9,50,000. Other 13,42,500. This is taxable at the rate of 30%. 9,50,000 into 30%. How much? 2,85,000. Next, 13,42,000. He is following 115 BAC na. If he follows 115 BAC, then tax rates up to 3 lakh there is no tax. Greater than 3 lakh up to 7 lakh tax rate is 5%. Tax amount is 20,000. Greater than 7 lakh up to 10 lakh tax rate is 10%. Tax amount is 30,000. Greater than 10 lakh up to 12 lakh, tax rate is 15%, tax amount is 30,000. Above 12 lakh, tax rate up to 15 lakh, tax rate is 20%. So 1 lakh 40,500 into 20%, 28,500. So how much is tax? 28,500 plus 80,000. 1 lakh 8,000. So how much is total tax? 2 lakh 85,000 plus 1 lakh 8,500. Total 3 lakh 93,500. To this you will add HEC at the rate of 4%. 15,740. How much is final tax liability? 393. 4 lakh 9,240. I hope you understood. So, do you also got the same answer? Today I am live from Vijayawada. Previously, I used to come live from Hyderabad. Later on, that incident happened to Ongole. Then came to Vijayawada. So from here onwards, I am taking class for you. So you also got the same answer? Please reply. Hello. Am I audible? Next, we will see registration process of the. Before we start with registration process of trust, I wanted to explain 1023C. See, as per 1023C, clause 3A, clause 3AB or clause 3AC. Whatever the income of government hospital, government school or hospital is there, that is fully exempt. Sir, when we call an institution or hospital as government institution or government hospital, when any hospital or institution is substantially financed by government, then we call such hospital or educational institution as government institution or government hospital. So if like substantially financed means what? Whatever the government grant that they receive, government grant is more than 50% of total receipts. Such type of educational institution or hospital we call as government hospital or government educational institution. Income of government hospital, government educational institution is fully exempt. It is not at all. 1023C, 3AD, 3AE. Private educational institution or private hospital whose aggregate annual turnover is less than or equal to 5 crores. Then also their total income is not taxable, their total income is fully exempt. Let's say I started one small school for the purpose of education. Okay, I am a private one. Like my trust is not a government trust, it is a private trust formed for educational purposes. But whatever the fees that I collect from students is there, it is less than 5 crores. So if you create any trust whose aggregate annual turnover is less than or equal to 5 crores, if it is either educational institution or any hospital, then whatever total income received by the trust or educational institution, it is not at all taxable, it is fully able to understand. 1023C, 4 or 5 or 6 or 6A. See, these people are there na. They are not required to obtain any registration, any approval from CIT or PCIT, any education institution which is formed solely for charitable purpose, any hospital which is formed solely for charitable purpose, whose aggregate annual turnover is less than 5 crores, they are not required to obtain any approval from CIT or PCIT. Their total income is fully exempt. However, in case of any private trust, educational institution or hospital whose aggregate annual turnover is more than 5 crore rupees, then they are required to get approval of CIT or PCIT. Approval of CIT or PCIT is required, then only exemption is allowed, otherwise exemption is not allowed. Then only exemption is available, exemption under section 1112, otherwise exemption under section 1112 is not. Okay. See, trustees registered under section 12AA or 12AB or trustees registered under section 1023C clause 4 or clause 5 or clause 6 or clause 6A. See, in either case, 11 and 12 exemption is available. If they get registered under 12A or 12AB, 11, 12 exemption is available. Or if they get registered under section 1023C4, 5, 6 or 6A, then also section 11, 12 exemption is available. So, Nirmalamma thought, our finance ministry is Miss Nirmala Sitharaman, right? She thought, see, in either case, exemption is available under section 11, 12. Then why registration under two different sections, 12AA, 12AB, 1023C4, 5, 6, 7? Why? Then, so with effect from 1st October 2024, if you want to obtain new registration, you can apply new registration only under section 12AB. You cannot obtain registration under section 1023C, 4 or 5 or 6 or 6. This is not allowed from 1st October 2020. The earlier two options are there. If you want to claim exemption under section 1112, either you can get registered under 12AA or 12AB, or you can get registered under section 1023C. But nowadays, this is the recent amendment made in Finance Act number 2 of 2024 with effect from 1st October 2024. If you want to apply for new trust registration, you have only one option. You can apply under section 12AB. You cannot obtain registration under 1023C clause 4, 5, 6 or okay. Now this registration I will explain in ICA material. Now see, 1st April 2021, remember this date. Before 1st April 2021, you have to get registration under 12A or 12AA. After 1st April 21, they introduced one new section, 12AB. Okay. See, before 1st April 21, if you take trust registration, lifelong the trust registration is there. TTD got registered, for example, in 1976. That's it. Again, they need not go to Commissioner of Income Tax. So whenever Income Tax Department is doing audit, when it asks for certificate of registration, they were not able to give. They are saying it got registered in 1976. Certain documents were not found. Irregularities are there. So Nirmala Sitharaman, after she became finance minister, she introduced one amendment with effect from Finance Act 2021. She said that every trust is required to get its registration renewal for every 5 years. That means what? Like today, if I take any registration under section 12AB, it is not for lifetime. It is only for 5 years. After 5 years, again I have to get my registration renewed. Okay, only if I get my registration renewed, then only 11 and 12 exemption benefit is available. Otherwise, section 11 and 12 exemption benefit is not available. Are you able to understand? Now, those trusts which are already existing as on 1st April 2021, they need to migrate from 12AA to 12AB. So for migration, they were given 3 months. So within 3 months, 3 months means what? 1st April 21, 3 months means 30 June 2021. So within 3 months, they should keep application for migration from 12AA to 12AB. However, 30 June 2021 was extended. Okay. You can see 30 June 2021, it is extended up to 30 June 2024. It got extended by circular 30 June 2024. So those who wants to migrate, those who are already registered as on 1st April 2021 are there, within 3 months, they need to keep application to commissioner or principal commissioner for migration to 12AB. Then commissioner will pass the order for registration under section 12AB within 3 months from end of the month in which application was received. So the month in which application is received by commissioner, he will ignore that month. Within next 3 months, he will pass the order for registration under section 12AB. Sir, when he is giving registration for migration from 12AA to 12AB, will he check any documents? Will he do any inquiry? He will not do any inquiry. Without any inquiry, he will give the registration, and that registration is valid for 5 years. Are you able to understand? The year in which a trust is created, from that year they can claim exemption for additional 5 years also. Are you able to understand? Last point, if you want to create a new trust, let's say today I got thought I wanted to start one trust for those who are unmarried. Okay, for unmarried people I wanted to create one trust under advancement of any other object of general public utility. So like for new trust, first I need to apply for provisional registration. They will grant provisional registration. Once I get provisional registration, then I should apply for final registration. So when should I make application? At least 1 month prior to commencement of the previous year relevant to assessment year. What is today's date? 24th July 2025. So today I got an idea. I wanted to start a trust for unmarried people. You know, right? If I start new trust today, then previous year will commence from 24th July to 31st March. Generally, previous year 1st April to 31st March. But if I want to start in case of new business, new source of income, new profession, previous year will start from date of commencement of business or profession or source of income. I'm starting trust today, so date of commencement is today. So this is previous year beginning. So I need to be upfront within before 30 days, before 30 days only, or before 1 month, I think. At least 1 month prior to the commencement of previous year. So 24 July, 1 month means 24th June 25. Before 24 June 2025 only, I should make application for provisional registration of the trust. The month in which application is received, ignore that month. Within next 1 month, commissioner will give provisional registration to. Are you able to understand? So within 1 month from end of month in which application is made, or application is made, order to be passed for provisional registration without detailed inquiry. So commissioner, principal commissioner, they will not do any inquiry. So I am applying for provisional registration. So I made application. The month in which I made application, ignore that month. Within next 1 month, I am going to get the provisional registration, and that provisional registration is valid for 3 years. Next, second point. Once I get a provisional registration, then I have to apply for final registration. Sir, when I should apply for final registration? So within 6 months from commencement of activities. See, I am starting trust now. I will do some activity. The date on which I started the activity, from that date within next 6 months, or within or before 6 months from expiry of provisional registration, whichever is earlier. So the date on which I start the activity, from the date within next 6 months, or the date on which provisional registration expires before 6 months from that date. Okay, I need to apply for final registration. When I apply for final registration, commissioner or principal commissioner, he will ask all the documents, he will go through the entire documentation, he will completely do inquiry upon my trust. After doing complete inquiry, if he is satisfied, he will grant final registration. If he do not satisfy, then he will give opportunity of being heard and he will reject the application for final registration. If he gives approval for final registration, it is valid for 5 years. Like those 5 years are to be counted from the year in which that trust application, provisional application for trust was made. From that year onwards, 5 years is 5 years that final registration will be granted. Trust is already registered under section 12AB. I said na, for every years they need to get renewal. So trust already registered under section 12AB. And it want, and 5 years time limit is over. 5 years time limit is getting over. Then it needs to apply for renewal na. So for renewal application, when it should apply for renewal application should be made 6 months before date of expiry of registration. So whatever date of expiry is there, for the date of expiry, you need to calculate 6 months. Before that 6 months only, you should apply for renewal of registration. Then if you apply for renewal also, like commissioner will go through entire documentation. If he is satisfied, he will renew your registration. Otherwise, he will reject your renewal registration after giving opportunity of being heard. Now renewal registration is again valid for another 5 years. Okay. If your trust is inoperative and you wanted to make it operative, let's say in 24-25 trust is inoperative. In 25-26 I wanted to make trust operative. So in 24-25 only, like I wanted to make it operative from 1st April 25. So from 1st April 25, I need to do back calculation 6 months. 6 months means 30th September 24. Am I correct? So before 30th September 24 only, I should apply for operation of inoperative trust. Are you able to understand? Then again, income tax officer will go through entire documentation. If he is satisfied, he will grant final registration. Otherwise, he will reject the registration after giving opportunity of being heard. It is also available for 5 years. All clause 2, clause 3, clause 4. All three are available for 5 years. Next, there is modification of objects of trust. If there is modification of objects of trust, then also the trust is required to make application for change of objects. Within 30 days from date of change of objects, it should make application. He will go through, officer will go through the entire documentation. If he is satisfied, he will grant registration. Otherwise, he will cancel the modification of object. Okay, if he grants registration, again it is valid for 5 years. So this is the concept relating to registration of. Now last concept, important concept, a question you will get in examination, that is tax on accreted income. This is also called as exit tax. Now, what do you mean by exit tax? This exit tax, this is applicable in 3 cases. What are those 3 cases? I will tell you. In these 3 cases, whatever the accreted income is there, that accreted income is taxable at MMR, maximum marginal rate. Sir, what do you mean by MMR? 30% tax plus 12% surcharge plus 4% HEC. So what is effective tax rate? 34.944%. That is effective tax rate. Now I will explain these 3 cases. In these 3 cases, whatever the accreted income is there, on accreted income, tax rate applicable is 34.944%. Let's say trust is closed. There is dissolution of trust. Till 30 years, I am claiming exemption under section 1112. I accumulated so much of assets. So what I will do at the time of closure of trust, whatever the income that I accumulated, whatever the income that is accreted is there, on such income I am required to pay tax at the rate of 34.944%. Are you able to understand? That is maximum marginal rate. Now, shall I discuss those 3 cases? Actually 4 cases, but in Act they were given as 3 cases. Now let us see one by one. Trust got converted into non-eligible form. Trust got converted into non-eligible form. What do you mean by this? Let's say non-eligible form means trust registration was cancelled. You know, like if income tax officer finds something suspicious, then commissioner has right to cancel the registration. If trust registration is cancelled, in that case, whatever the accreted income is there, on such accreted income, you are required to pay tax at the rate of 34.944%. Next, trust made modification of objects. Just now we have discussed, if trust made modification of objects and not applied for fresh registration, or applied for fresh registration but it got cancelled, applied for fresh registration but got. So in these cases, whatever the accreted income is there, on such accreted income, tax is applicable at the rate of MMR, maximum marginal. So first, trust registration is cancelled by commissioner, or trust made modifications and it did not apply for fresh application, or it applied for fresh application which is cancelled by commissioner. In these cases, whatever the accreted income of trust is there, on such accreted income, trust is required to pay tax at the rate of not migrated from 12AA to 12AB. You know, right, after 1st April 21, every trust is required to migrate from 12AA to 12AB, but they did not migrate from 12AA to 12AB, or not renewed registration under section 12AB after 5 years. See, for every 5 years, it needs to renew its registration, right? But trust failed to renew its registration after 5 years under section 12AB. Then also, like whatever the accreted income is there, on that it is required to pay tax at the rate of MMR. Next, after provisional registration not applied for final registration. In this case also, like accreted income, on such accreted income, it is required to pay tax at the rate of M. Case 2. Trust merged with another trust. it got merged with another trust. Another trust is not registered under section 12AA or 12AB or 1023C, 4 or 5 or 6 or another trust is registered but not having same object. But not having same object. That means what? If one trust gets registered with another trust, sorry, if one trust gets merged with another trust which is unregistered, then also accreted income concept is applicable. Registered trust getting merged with another registered trust. Registered, like I'm in educational field, education trust got merged with hospital trust. Even though both are registered, still accreted income concept is applicable because both objects are not same. If there is dissolution of trust, what you need to consider? You need to consider date of dissolution. From date of dissolution, from end of such month, within next 12 months, it need to transfer all assets to another registered trust having same objects. Another registered trust having same object. Then whatever the assets transferred to another registered trust having same objects, on that tax is not levied. Whatever the not transferred are there, on those not transferred assets to another trust having same objects, on this MMR is applicable. Tax is required to pay at the rate of M. Now, what do you mean by accreted income? Here I said accreted income. Sir, what do you mean by accreted income? Accreted income means fair market value of all assets less total liabilities. Whatever the balance is there, that balance we call as accreted income. Here, another important point is there. When you are calculating fair market value of all assets, you need to exclude three assets. Three assets are excluded. First, asset purchased out of agricultural income. That means if any asset is purchased out of agricultural income, on that asset will not be considered in calculation of accreted income. On that asset, MMR, maximum marginal rate tax, is not applicable. Next, second, asset purchased before 12AA or 12AB registration. So if you purchase any asset before obtaining registration under section 12AA or 12AB, see, only if you obtain registration under 12AA or 12AB, then only you will get 11 and 12 exemption. Before that date, there is no concept of 11 and 12 exemption, right? So if you purchase any asset before obtaining registration under 12AA or 12AB, that asset is purchased out of tax paid money. Already you paid tax in earlier years. Now again, why will they levy maximum marginal rate? That's why if you purchase any asset before obtaining registration under section 12A or 12AB, that asset is to be excluded while you are calculating accreted income. Third, assets transferred to another registered trust having same objects within 12 months from dissolution date. So whatever the assets that are transferred within 12 months, we have discussed this point, right? If you transfer within 12 months to another trust having same objects, then whatever the assets that you have transferred, on that no tax is required to be paid. Whatever the untransferred assets within 12 months are there, okay, on those accreted income, you are required to calculate tax at the rate of MM. See, whatever the tax at the rate of maximum marginal rate is there, that is required to be paid within 14 days. Are you able to understand that 14 days is required to be calculated from date of is from expiry of 12 months, you need to pay within next 14 days, or if there is modification of objects from date of cancellation of modification of objects within next 14 days, you need to pay maximum marginal rate tax on accreted income. Otherwise, interest will be levied. Now, valuation. Here it was there. You can see the valuation also. I will explain in simple terms. Valuation. How to calculate fair market value of assets valuation. If it is immovable property, it is calculated at stamp duty value or fair market value, whichever is lower as on valuation. If there are quoted securities, then you need to consider lower price plus highest price divided by 2. Nothing but you will consider average price on the date of valuation. If there are unquoted securities, then you will consider A plus B minus L divided by PE into PV. Don't worry, I will explain you. Let's say trust is there. Trust is having 10,000 shares in Reliance Industries Limited. Now, let's say Reliance Industries Limited balance sheet is there. In this balance sheet, let's say equity share capital 60,000 shares, 6 lakhs, current liabilities 10 lakhs, fixed assets 80 lakhs, current assets 5 lakhs. Now, what you will do? You will consider fair market value. Let's say fair market value is 90 lakhs. 90 lakhs plus 5 lakhs, current liabilities minus 10 lakhs divided by total number of shares 60,000. How many shares trust is having? 10,000. So 10,000 shares means nothing but PV, 60,000 shares means nothing but PE, and this 90 lakhs plus 5 lakhs we call as B, and 10 lakhs is liability. See, if there are gold, jewelry, immovable property, for all of them you will consider fair market value. For any asset which you will not consider fair market value, you will consider book value. That's how we are going to arrive A plus B minus L divided by PE into PV. So we are going to calculate value of unquoted shares. So if there is any other asset, you will consider fair market value. Fair market value on valuation. Shall we do one problem in ICI module so that you will get better understanding? Let's do 7th problem in institute material. Helpage is a charitable trust set up on 1st April 2010 with the object of providing relief to the poor. Later on, in April 2012, it changed its objects to medical relief. So when it was formed, 1st April 2010, correct? So at that time, objective is relief of poor. When it changed its objects, on 1st September 2012. So the object was changed. What is the objective? The objective is to provide medical relief. Again, it applied for registration on 1st April 2013 for 12AA. That means During this period, there is no registration under section 12AA, right? As there is no registration under section 12AA, no exemption can be claimed under section 1112. No exemption under section 1112. That means what? It has paid taxes during 1st April 2010 to 31st March 2013. From 1st April 2013, it took 12AA registration. So it is eligible for exemption under section 11 and 12. Exemption under section 11 and 12 is on 1st April 2024, HelpAge got merged with PoorAid. He is not eligible for registration under 12AB or approval under section 1023. So what happened on 1st April 24? HelpAge merged with PoorAid. See, PoorAid is also another trust, but is it registered trust? No, it is unregistered. So when one trust gets merged with another trust, okay, another trust which is not registered, in such a case, like it is required to pay exit tax. I told now in 3 cases. Now HelpAge registered trust under section 12AB, it is getting merged with unregistered trust. As it is getting merged with unregistered trust, it is required to pay tax on accreted income at the rate of maximum marginal rate. So assets were given: land, immovable property. What will we consider? Stamp duty value or fair market value, whichever is higher. 1st September 2010, that means before 12AB registration. So if any asset is purchased before 12AB registration, that should not be considered in calculation of fair market value of assets. Next, 1st September 2013, stamp duty value or fair market value, whichever is higher. That means we will take 120. Shares, quoted shares. For quoted shares, you need to consider average price. 320 plus 300 divided by 2, 310 shares into 5000 shares. How much? 5000 into 310. 15 lakh 50,000. Next, 2000 preference shares. What you need to consider? Fair market value. For any other asset, you will consider fair market value. 2000 into 180, 3,60,000. Next, book value of liabilities 120 lakhs. Corpus fund. Corpus fund is like share capital, right? Share capital is not treated as liabilities. That should be excluded. Another important point. Here, fair market value of all assets minus liabilities, right? While calculating liabilities, you should exclude corpus fund. That means corpus fund is not a liability. Provision for tax is also not a liability. See, generally provision for tax is liability, but for calculation of accreted income, provision for tax is not a liability. Next, if any reserve is there for dividend, that reserve for dividend is also not a liability for calculation of accreted income, and reserves and surplus are to be excluded. Reserves and surplus is also not a liability. Next, provision for contingent or unascertained liability, that is also not a liability for the purpose of calculation of total liabilities. Are you able to understand? So all these items you should exclude. So whatever the items are there, all these you should exclude while calculating liabilities. So here liabilities are 120 lakhs. From 120 lakhs, you should exclude corpus fund, because corpus fund is not a liability. 12 lakhs you will exclude. Next, provision for tax. It is also not a, generally it is a liability. For calculation of accreted income, it is not a liability. Next, reserves and surplus 18 lakhs. After you reduce all these three, 120 minus 12 minus 8 minus 18, 82 lakhs. So your total liabilities are 82 lakhs. Now shall we calculate accreted income? accreted income. Fair market value of all assets. So immovable property you will consider 120 lakhs, right? Land. Next, quoted shares. How much you will consider? Quoted shares 15 lakh 50,000. Next, unquoted shares 3 lakh 60,000. So how much is fair market value of total assets? 1 crore 39 lakh 10,000. From this we are going to reduce liabilities. We have calculated liabilities na. While calculating liabilities, we should not consider corpus fund, we should not consider reserves and surplus, we should not consider any reserve for dividend, we should not consider provision for tax, we should not consider provision for unascertained or contingent liabilities. So we have calculated na 82 lakh rupees. So how much is accreted income? 57 lakh 10,000. On this accreted income, tax rate applicable is MMR, maximum marginal. So 34.944%. How much? 19 lakh 95,302 point. So this is the tax that they need to. Now let us check the answer. As no one is there to tell me the answer, what can 19 lakh 95,302 we got rounded off to a previous multiple of 10, which is nothing but 19 lakh 95,000. So dear students, this is the concept of trust taxation. I hope you understood this revision very well. If you like this, please share with your friends as well. Thank you very much. Let's meet tomorrow with. Okay.